All right, thank you everyone for coming. Good afternoon and welcome to today's Advanced Practice Center webinar. My name is Kevin Velasquez and I'm a Senior Marketing Manager with NAIFA. Along with the Society of Financial Service Professionals, we're really happy to collaborate on the Advanced Practice Center to bring you events like these, featuring insights and content from industry thought leaders. If you want to learn more about the Advanced Practice Center or find out more about either NAIFA or FSPs, be sure to visit the apcenter.org for more info. Before we get started, I did want to say a bit about today's continuing education credit. For today's live webinar, the credits available are 1 professional recertification credit, 1 CPE credit for accountants, and 1 CFP credit. If you requested credits when you registered, a certificate of completion will be emailed to you in a week or two, assuming you successfully complete the webinar. Also, for accounting credit, be sure to respond to the 3 attendance check questions when they appear during the webinar. The attendance checks are only required for accounting credit, not CFP or professional recertification. If there are any questions about CE credits, you can ask them via the Q&A feature in Zoom or contact us after the webinar has concluded. Now, I'd like to turn it over to our presenters for today, John Snider and Matthew Gibson of John Hancock, who will talk to you about behavioral insurance. If anyone has any questions about the topic during the webinar, we will leave time at the end for John and Matthew to answer. So without further ado, I will turn the virtual floor over to them. Thanks, John and Matthew.
Thanks, and I guess good afternoon or good morning, depending where you are in the country. So today we're going to be talking about, is behavioral insurance the future of life insurance and what that means. But I think it's important to set the stage as to what I'm referring to and why this is a conversation that we're having with you all today. And I think first and foremost is to understand what the traditional policy experience looks like. The traditional policy experience that exists as of today is fairly dated, and candidly, it's not the best experience for a client. They go through an underwriting process, right? And regardless if it's best case scenario, it's accelerated, or otherwise they go and get lab work done, and then they finally get their policy. And what do they do with it? They stick it in a drawer, never to see, feel, think, or touch it again. And then every year they get a bill and they pay the premium and rinse and repeat year after year after year and repeat that for the entire policy duration. And then they get a death benefit paid, or if it's a term policy, they outlive coverage. And that's the quote unquote ideal outcome, is either a death benefit is paid or they outlive coverage. And I'm not here to suggest that the important peace of mind that exists from a life insurance policy isn't important. It's just that this is the paradigm that consumers live within when they're buying an insurance policy. It is fundamentally viewed oftentimes as an expense. So taking that a step further, it's important to understand what we're talking about then. So on top of improving that customer experience, behavioral insurance, or BI, oftentimes referred to, is changing that customer's experience because they're in a unique position to influence their health, which continues to answer the why behavioral insurance conversation. So there are 4 lifestyle choices, behaviors, that are smoking, excessive alcohol consumption, poor nutrition, and lack of physical exercise that lead to 4 of the leading chronic lifestyle diseases, which are diabetes, respiratory and cardiovascular disease, and cancers. And that represents over 71% of deaths worldwide. So the simple response to this is we all should just make better behavioral choices. But we all know that that isn't as just easy. Human behavior is complicated, and it's a result of where that shared value and behavioral insurance can come into play. So this begs the question of what we are hopefully all here today to understand is, what is behavioral insurance or shared value insurance? Simply put, behavioral insurance is insurance that is dynamic. It's based upon the behaviors, as the name might suggest, of a consumer, instead of just a static, singular point in time process. And it's also one that rewards customers for good behaviors. So it's a carrot-only approach. There's no stick in the approach that's here. And behavioral insurance and shared insurance is really everywhere. It exists in the auto insurance space, right? There's a lot of auto insurance platforms that use a telematic or a mobile app that is based upon safe driving habits to drive premium discounts on auto insurance. It also exists in the health insurance place with wellness programs that can provide either credit or health savings account contributions that are linked to positive health behaviors. And even something as simple as home insurance, where there's discounts that are applied on home insurance coverage for utilization of home security or smart locks, smart windows, doorbell cameras. There's a lot of smart home technology that exists that is being leveraged in the home insurance place to drive a premium discount on home insurance. And this is all done through what we refer to as shared value. So shared value is created when companies innovate to address social problems, as well as driving key business objectives. So for the insurance industry, there's obviously natural alignment when it comes to customers living a longer life, right? If customers take steps to live a longer life, that contributes to longevity. It's good for them because they're still alive. And it's obviously good for the life insurer because we haven't paid a claim on death. We're able to defray that claim out until maybe instead of 80, it's 83 or it's 87. That's obviously good for us as a life insurer. And this is really the driving philosophy behind behavioral insurance or shared value. If you're able to encourage customers to take those healthier steps, health results and mortality improves, which provides value to the insurer, and the insurer then can share that value back to the consumer for those healthy actions and use that as, like I mentioned previously, the carrot to drive those future positive behaviors to drive even further health results, and then back that cycle continues. So it's really important to understand the broader picture here. So this is really allowing the model to shift. Behavioral insurance allows the industry to shift from a more passive product provider or claims only provider model to one that really helps partner with the consumer as an active risk management. So in 2015, John Hancock really was the first life insurer to do that. And we did that when we launched John Hancock Vitality. So to level set what that is that's really, we teamed up with Vitality, who is really the global leader in linking life insurance to wellness solutions to bring behavioral insurance to market. Vitality operates in 40 different markets across the country with over 30 million Vitality members in that space. So we are not the only carrier that is doing this globally. However, we are the only carrier in the US marketplace that is working with Vitality on this. So to provide a little bit more context to that, how Vitality works is fairly simple and straightforward. Customers and your clients can accumulate Vitality points for simple health-related activities that they're doing or behaviors, like walking, eating healthier, getting regular checkups, getting a flu shot. They get credit for those things, and those will attribute to a Vitality status by earning those Vitality points. The higher the status, there's premium savings in that shared value model that I just talked about, up to a 25% premium savings component, as well as rewards and benefits within that space. So when we talk about those behaviors, what type of behaviors am I talking about? Healthy behavior is a very kind of nebulous conceptual idea, but these are behaviors that we're really talking about. Reaching those Vitality statuses to earn those discounts, right, are fairly simple, and we really make it very transparent. There's lots of ways to participate in these type of programs. So shown here is just a quick way of just some of the ways. So it's like annual health screenings. Are those health screenings in a healthy range? Are you continuing to be a non-smoker? Do you meditate? Do you get a full night's sleep? Access to education and resources online. Do you exercise? Do you go to the gym? Do you simply work out at home? Those types of things are positive health behaviors that we actually can provide reward and benefit to the program. Now, again, that all seems simple. These are just like, oh, well, you're talking about incentivizing consumers for those health behaviors. How do we do that? Well, that's where Vitality comes into play. So we have two forms of Vitality. The first is Vitality Go, and that's included automatically in all John Hancock insurance products at no cost. And Vitality members will gain access to the platform, discounts for achievements of those healthy goals that they're putting in place for themselves, as well as access to nutrition and fitness resources available. But for a $2 a month charge, consumers can gain access to a broader version of this where the premium savings come into play, access to fitness and wearable devices, and other additional rewards and benefits, including things from Expedia, REI, Amazon, Starbucks, a lot of different components within that. But these are in place to drive those healthy behaviors. So it begs the question of that's great and all, but are consumers interacting with behavioral insurance, or more specifically, John Hancock Vitality? And the short answer is simply yes. Consumers are engaging in these types of programs. So at John Hancock, 92% of members are actually realizing that financial benefit of their participation within the programs. So this is not just about, oh, they got a fitness device that counts as benefit. No, these are actual policy level enhancements that exist to do that. So 92% of members are actually seeing policy level enhancements as a result of these behavioral insurance programs. Now, the question then people tend to ask is, well, even if they do engage, are they going to stay engaged in programs like this long term? So we're actually seeing that 85% of members are staying engaged year over year. Now, I will say this perhaps will be the only time in a presentation where I am going to go through the footnote. So you might be thinking, Matt, you just cherry picked this 85% number. We're actually looking at policies that have been enforced for at least 4 years. So back to 2015 through 2017, what are we looking at in here? Are these people staying engaged year over year over year over year? Don't tell me that, oh, I want to know. The analogy I tend to make is, when people join a gym, obviously the gym is very crowded in January. But is that gym crowded in October, November, December, the following year, the year after that? Well, the fact of the matter is that we are seeing engagement be very sticky, and consumers like this type of insurance structure. And they actually like it up so much, they're actually engaging in behavioral insurance platforms like John Hancock Vitality up to 4 times a day. That's obviously much greater than that simple relationship they had at the front of my comments today of just interacting with a bill every year. And perhaps more importantly, behavioral insurance and solutions like John Hancock Vitality are becoming more relevant to consumers. We actually saw an increase of customer engagement by about 20% during the pandemic due to the fact that there's a lot of people focusing on health and wellness as a result of the pandemic. But you talk again, Matt, you're talking about shared value. Of course, consumers are interested in getting benefit and saving on their premiums, but what does this mean for the insurer? Again, that only works if there's value in that cycle that I mentioned. Well, fact of the matter is that consumers are making healthier choices, and it is resulting in positive outcomes at the insured level. So we're seeing members, 80% are reporting similar or better health year over year, which is really important to understand. Is generally speaking, as people get older, they generally don't become healthier as time goes by. But we're seeing people actually stay the same or become better year over year. And we're seeing that reflected through medical results, improved body mass index, improved blood pressure, improved cholesterol. Now, I'm not suggesting that we have seen massive mortality shifts in just the 7 years that we've had Vitality in place. These are leading indicators to these types of behaviors or driving these health outcomes, which in turn will manifest in longer-term mortality enhancements and improvements over time. This is really important to understand. So, but what does that mean for the advisor? You talked about that shared value approach. What's good for the insurer? What's good for the consumer? You can conceptually understand that's obviously good for society at large if people are healthier. But what does it mean for you and your practice? Behavioral insurance really can do a lot more to that. Consumers are more engaged in the sales process. They are more engaged in the solution that's being placed in front of them. If we look at our book of business of Vitality cases that have Vitality elected versus ones that do not have Vitality elected, they are more likely to be placed in force than their brethren that don't have Vitality Plus elected. So again, consumers are more interested in that. They actually have a higher satisfaction rate with the broker that they're working with, which is typically 3 times higher than the typical average of what like net promoter score, if you're familiar with what that is, of the individual broker. So you're actually seeing higher satisfaction of the individual who's sold them that contract than in the absence of it. And more importantly, consumers are saying that their purchase decision was based off of some level of influence through the behavioral insurance offering. Because at the end of the day, it's really important to understand about that shift. It's changing the old model, which is static and throw it in a drawer, and it's really shifting it forward. So there's really a lot of value you can bring into this. So for what does this also provide from a value add perspective is there's a wider and larger market to serve when it comes to behavioral insurance. I think a lot of people who maybe either young and healthy, they tend to not buy insurance, unfortunately, right? We're all familiar with the statistics about the coverage gap. This is a great solution of, hey, let's get coverage now for the benefits that you've outlined, all the rewards and components. It's a great reason to lock in that insurability today. It gives a much larger market to serve. Or consumers that have otherwise passed on the insurance conversation because it wasn't relevant to them, regardless of their age. This gives you a new method in. It's like, hey, we talked about life insurance previously. There's this new concept of life insurance called shared value insurance or behavioral insurance. Let me tell you about that and how that actually might be a better solution for you. Now, you tend to see more referrals and happier clients, as mentioned in the results, that there's a higher satisfaction for the producer, but also tend to understand, as much as we all would love to think that our customers are hanging out in someone's backyard telling you, oh my goodness, let me tell you about this amazing life insurance policy that I just got positioned to me. Customers don't have those conversations. As much as we wish they did, they simply don't. But the conversations they do have is, hey, you know what? I just got back from vacation and I saved on that trip through a benefit that my life insurance broker showed me. Or I am becoming healthier, or I have detected this particular medical condition earlier than I otherwise would have because I'm focused and paying attention to my health as a result of something that my insurance broker had a conversation with me about. Those are the conversations that people have every day, right? We don't talk about, oh, let me tell you about my life insurance policy. It's about the benefits that they're getting today, and that's really value to you. But it gives you an opportunity to use those conversations to have those either upsell or cross-selling opportunities. You know, does the premium savings illustrated in behavioral insurance allow them to buy up to, quote unquote, maybe a larger face amount contract? Or does that make perhaps an additional benefit or rider more within their premium budget? But also use it as a method of cross-selling other services you and your practice may actually have. So let's just say I was a customer, I hit gold vitality status. As a result, my premium went down and I got a bunch of ancillary rewards and benefits. If my advisor were to reach out and say, hey, congratulations on reaching gold, that means your policy is performing better than we initially suspected. There's other components in the program I want to make sure that you're available and aware of. But also, there are things that me and my practice do, or even take that a step further. There's other solutions. Do you have a friend that would be interested in a conversation like this, or a family member interested in a conversation like this? They're more likely to have that conversation with you at that point in time because they're associating you with all these positives, right? And I think perhaps most importantly, there is a lot of conversation right now about inflation. Inflation is top of mind for many people. You can't turn on the news and not hear some sort of segment about inflation. And the fact of the matter is that there's traditionally only two ways to get money into a life insurance contract. That's either pull out your checkbook and write a check, or some level of rate of return. I don't care if it's a dividend, an interest credit, an index segment, what have you. But solutions like behavioral insurance, and in turn, John Hancock Vitality, which is, I guess, my reference point here, is it gives the consumer a third mechanism of impacting their policy's performance that's uncorrelated to the market or inflation. And it gives them access to almost like additional monies into the contract itself. So it's really important to understand. So I think hopefully you all understand the concept of behavioral insurance. But now I want to shift over to my colleague, John, who's going to spend a little bit of time about how behavioral insurance can actually work in those more complicated planning opportunities. So John, take it away.
Thank you, Matt, very much. And thank you all for joining us. My name is John Snider. I'm an Assistant Vice President and Associate Counsel at John Hancock. I have more than 30 years of experience, starting out in a large nationally recognized law firm, and then shifting out of private practice into the advanced markets world. Matt, what you've shared with us is so exciting. The whole concept of shared value and an insurance company being on the same page with the insured, both wanting the same thing, for that insured to live their best life. And so the insurance company, with all of their resources, continuing to enhance that behavioral insurance program to bring new information, innovative ideas, even medical advances out to the insureds who are participants in that program. It's so exciting. My wife and I both own behavioral life insurance contracts, and I can't tell you the gratitude that I feel toward the insurance agent, the insurance company, and the peace of mind that I feel that some of the offerings in that behavioral insurance program might actually save our lives. It's really a game changer, such that life insurance is now for the living. So is behavioral insurance the future of life insurance? I personally believe that it is. And we're going to talk about just a couple of advanced markets applications and how behavioral insurance enhances those conversations. But even before we get to advanced cases, remember that even in very simple situations, every insured that you're working with, whether they're looking for new coverage or whether you're helping them evaluate the effectiveness and efficiency and adequacy of their existing coverage, please consider whether that client would be better off with behavioral life insurance. Behavioral life insurance has changed dramatically, and every year the change seems to grow faster. So if you're not talking about it with clients, there's a reasonably good chance that another professional will come in behind you, and your clients may be calling you to ask, why didn't you tell me about these innovations? So let's go ahead and advance. And if you would please, this is part of the CE, making sure you're still with us. If you would please answer that first question on your screen. All right. So the first advanced markets example we're going to talk about is in the business planning context. And so here, an employer is going to look at behavioral insurance to help them recruit, reward, and retain key employees. And we're going to look at an executive bonus plan, which is also called a 162 bonus plan. So let's continue and get into some of the reasons why an employer might have a keen interest in behavioral life insurance as part of this overall design. First, for employers, turnover is extremely costly. We know that the labor market is tight. We hear it in the news all the time about employers are having a tough time finding enough employees to work for them. So employee retention is a top concern for employers. And in fact, studies indicate that it costs employers on average more than 200% of the first year's compensation for an employee to get that new hire in the door, to go through an onboarding process, a training process, and after some training, then that new employee starts to be productive. But as you can see on the slide, the real return for the employer on employee hires accrues over time. That is, the employer has a strong financial incentive to retain that key employee with the organization. And as the employee engages and learns more about the company's products, systems, personnel, how to solve problems, that employee becomes more and more valuable to the organization. And So let's now turn our attention to what employees want in this process. So in terms of what employees want, 91% of employees at small and medium-sized businesses surveyed viewed the benefits that you see there on the slide as an important part of the employee's job satisfaction. And you can see that these non-insurance benefits are grouped into three categories. We would expect the financial category, whether that's paid maternity or paternity leave, financial planning resources, student loan assistance, tuition assistance. Employees value those types of benefit offerings from employers. Let's shift to the right-hand side of the slide there. Employees also value flexibility. That is, generous paid time off, more flexible hours. The survey said unlimited vacation time. I'm not aware of any employers offering that. But work from home option as well. That's a very important benefit to employees in terms of overall job satisfaction. And then pet-friendly options working from home might fit into that if your dog isn't too noisy. And then, of course, well-being. And this is really where behavioral life insurance can add some value in this overall conversation. When we look at employee well-being, in the survey, they were focused on things like gym memberships, fitness, health and lifestyle coaching, on-site gyms, personalized health coaching. So some things that are very much in the rubric of employee health and well-being. And so you're going to see a nice fit between behavioral life insurance and some of these things that these key employees would see as a value. So let's continue and take a look at what employers want out of these arrangements, because when we're doing advanced planning, those planning solutions that you bring to your clients are always a direct response to the client's goals and objectives, moving them forward from where they are now to where the planning strategy might take them. And so employers want plans that create loyalty. They want plans that avoid turnover and help with talent acquisition. And this all relates again to how difficult it is to find new employees and the cost of employee turnover that we talked about a little bit earlier. Employers also want selective group offerings. That is, here, from an advanced markets perspective, we're talking about non-qualified executive benefit plan options. We're talking about plans that will benefit a select group of highly compensated employees. And so these employers would really be harmed economically if they lost some of their top talent. And so a plan like an executive bonus plan is going to be implemented selectively to help the employer reward and retain that highly compensated employee. Next, employers would prefer plan types generally that entitles the employer to a tax deduction, which is generally the case here with an executive bonus plan, as long as the compensation that the employer pays out to the employee is reasonable. And we'll talk more about that in a moment. And then, of course, for anything that an employer is going to be offering for the benefit of employees, employers want that to be cost efficient. So, with that, let's get more specific on the next slide and look at why employers care about employees' wellness engagement. And so what we're looking at here is from a RAND employer survey, a percentage of employers reporting benefits from the employer's wellness program. And so behavioral insurance is actually similar, offers some benefits that are similar to a wellness program. And with the behavioral insurance, again, we're targeting a select group of highly compensated employees. But in the survey, the employers with wellness programs reported these benefits. 61% reported a reduction in their healthcare costs. 78% indicated that the employees participating in the program had decreased absenteeism, and 80% reported that the benefit program increased employee productivity. That's all of that is what employers care a lot about, and many employers too have a genuine care for the health and well-being of the people who they're working with in that employment organization. So let's look again at how behavioral life insurance can fit into this conversation. So we know that death benefit protection of life insurance is the cornerstone of the life insurance offering. That protection is absolutely critical. It is what drives the need for the purchase. So beyond death benefit, how else does life insurance and behavioral life insurance in particular help? Well, permanent life insurance may assist with supplemental income needs for that employee when the employee owns a policy funded with enough cash value and under the modified endowment contract limits that the employee can access cash value either by withdrawals or loans against that contract on a tax-favored basis. And we've talked specifically in Matt's section about health and well-being and how behavioral insurance promotes the health and well-being of that employee. And these are really exciting times for behavioral life insurance. The advances just keep coming. So it's almost like a holiday celebration when your behavioral life insurance carrier unveils a new component to their program. What will they think of next? And how is this going to benefit me as the insured? So there are fabulous benefits here for these employees. In addition, in the planning technique that I'm talking about here, the executive bonus plan, where the employee is the owner of the policy, the employee is purchasing this life insurance contract individually with the behavioral insurance component. That is all voluntary on the employee's part. The employee can, of course, apply for a long-term care rider with that policy, or a chronic illness rider, or I should say, and a critical illness benefit rider. All of those things are important benefits for that individual employee. And then, of course, with regard to flexibility, there's a tremendous amount of flexibility in these programs because, number one, the employer is focusing on a select group of highly compensated employees. And so the employer is determining who they're going to offer executive bonuses to and in what amount and for how long. So there's flexibility in terms of the structure and the employer's cost. There's also flexibility in terms of how the employee wants their particular life insurance contract to be designed, what type of policy it is, and whether that policy is focusing on death benefit or cash value, for example. In fact, why don't we go ahead and go to the next slide, and we'll look at some of the structural components of this. So here, and relate this back to the flexibility conversation. If you'll start with the diagram on the bottom of the page, the business and the key employee, or that select group of key employees, are going to enter into an agreement. So the client's attorney, the business's attorney in this case, is going to draft an executive bonus agreement that specifies how much the employer is going to pay out to the employee and under what conditions. For example, the bonus might be a certain dollar amount every year that the employee stays with the company for a certain number of years. As long as that compensation is reasonable, the business will take an income tax deduction for that bonus as the compensation is paid out. So think of this as a cash payment from the employer to the employee. The employee is going to pick up that compensation as additional taxable income, just like they do their other wages that are paid from that employer. The employee then makes a voluntary decision to purchase a life insurance contract, and they can add the behavioral life insurance component to that, and they have the choice to participate in that program. And as I've been talking about, that policy may provide a variety of benefits to either the employee or the employee's beneficiaries. A couple of those benefits might include tax-favored supplemental income and the tax-favored death benefit. In terms of structure, again, this is one of the simplest executive benefits designs. The policy is owned by the employee. For administrative convenience, the employer might pay all or a portion of the premium on the policy directly to the insurer. But for tax purposes, what's happening is the employer is paying compensation to the employee, and the employee is purchasing the life insurance contract. And we've gone through the other points there, other than to say that the employee has full control of this life insurance contract and has full access to all of the policy values and benefits. So let's continue. As I've mentioned, one of the wonderful advantages of this 162 bonus plan type is that each employee can customize or tailor their policy to exactly what that employee needs. Some employees may need more death benefit for income replacement, or to pay off a mortgage or other debts, or provide maximum liquidity at death for other obligations. Other employees may want less death benefit relative to the amount of cash value that's accruing in that contract. That is, they may prefer a contract that's funded much more heavily for maximum cash value accumulation just under the modified endowment contract limits, so that they can also benefit from the tax-favored access to those policy values. And as I said, other riders, such as the long-term care rider or a chronic illness rider or critical illness rider, could be applied for if the employee wants those types of protections as well. So it's very important that for any advanced markets design, the client's attorney and the client's accountant need to be part of the planning team. The client's attorney is going to be the one that determines, based on the facts of a specific situation, whether or not this is a welfare benefit plan for ERISA purposes. If the facts indicate that it's not, that's fine, they move forward. If the facts indicate that it may be a welfare benefit plan for ERISA purposes, then the client's attorney would be looking at filing a top hat letter with the Department of Labor, just as they would with a non-qualified deferred comp plan for a select group of highly compensated employees. And then as part of these considerations too, depending on the insurance carrier involved, the insurance carrier might offer some type of express underwriting that is a little lower touch than has historically normally been required for some or all of the employees who are applying for policies. So there's a tremendous number of benefits here for employees. Let's continue, and we'll look a little more specifically. As I said, the death benefit is always a very important consideration in any life insurance design and sale. For some employees, or for some individual policy owners, even when there's no employer involved, those policy owners are also looking at the tax-favored cash accumulations in the policy as an additional benefit. So here we're showing a slide that our viewers are probably very familiar with, where we take a look at the general attributes of a number of different items that might appear on that employee or other client's balance sheet, whether that's life insurance, taxable investments, qualified plans or traditional IRAs, Roth IRAs, and municipal bonds. And then you can go through when you're working out what are the attributes that are most important for the client, what's the client's overall plan and situation, how might life insurance fit into that situation. And so you can help the client analyze, do they want a policy that has more cash rather than less cash accumulation in it? Are they interested in tax-favored withdrawals or future tax-favored loans from that contract? Also looking at how life insurance cash values are treated from a tax-deferred accumulation perspective, and the tax-favored death benefit. Generally, death benefits are received income tax-free. Also, with regard to life insurance, typically these policies are structured, as I've said, so that they're not modified endowment contracts. If there's too much cash put into those policies, and there are some tax code tests for how much in terms of premium payment creates a modified endowment contract. If the contract is a modified endowment contract and the, let's say, insured owner in this case takes a withdrawal or a loan or pledges that contract as security for a loan, if the contract is a modified endowment contract and the insured owner is less than 59 and a half years of age, there's a 10% penalty that can be applied on that withdrawal to the extent there's gain in the contract. But typically, we're not working with modified endowment contracts in these designs. Also, in terms of specific tax code limitations, there's not the same hard contribution limitations like there are for qualified plan and IRA contributions with respect to life insurance. There are some code sections that define life insurance and modified endowment contracts, but there's typically quite a lot of room for clients to put premium into these designs. And then life insurance, of course, with the death benefit being a primary benefit, there is cost of insurance charges that's part of the evaluation process. And depending on the policy type that's being chosen, the client may or may not be incurring market risk with respect to that, to the cash value buildup in that permanent life insurance contract. So the planning team needs to take a look at the product type as well as how funds are being allocated within that product type. So with that, let's continue and look at, in the advanced market space, there are always more options. And so we've really seen how the behavioral life insurance enhances the conversation and can really help employers look at some things, give their employee a way to obtain some coverage with a behavioral insurance component that employee is really going to value. If the employer is looking for something else, for example, if the employer says, well, I would like a plan type to give me as the employer some cost recovery. I like the 162 bonus, but I'm just paying out money every year and the employee can walk away with that. There are other advanced markets designs that can give the employer greater cost recovery or additional handcuffs or control in that situation. So some of those additional advanced markets considerations could be, or other design types would be adding a restrictive endorsement on that contract, where if the employee leaves within a certain period of time, the employee has to pay a penalty back to the employer. Or there are various split dollar designs. You see a couple on your screen there, loan regime split dollar. Really we could broaden out that endorsement split dollar to economic benefit regime split dollar, and encompass both endorsement split dollar and collateral assignment split dollar. Both of those can give cost recovery to the employer. And then, of course, another more involved design is more traditional non-qualified deferred compensation, using employer dollars in a SERP design, perhaps combining that with allowing the employee some elective deferrals as well in that plan, or we could look at a straight salary deferral plan. So there are a number of options to look at. What gets chosen in a particular case depends on everyone's goals and objectives. And as I've said, the client's attorney and accountant are very important planning team members in these types of cases. So with that, let's move out of the employment context and take a look at an estate planning or legacy planning area. And we'll do this quickly. In an estate planning or legacy planning case, one option that we've seen that's very popular is a client using a Dynasty Trust with behavioral life insurance. And they're doing that to create a legacy that's promoting health and well-being for their descendants who will be beneficiaries of that trust, and continuing this arrangement for multiple generations. So let's go to the next slide, and we'll take a deeper dive here as far as what we're talking about. So a Dynasty Trust is an irrevocable trust that's drafted to continue for multiple generations. Often the client's attorney will draft a trust like this to last as long as applicable state law allows. And in a handful of states, there's no duration limit on trusts of this type. And Dynasty Trust assets, that is, assets that are put into this trust in various ways, but primarily by gift. Those assets, when, let's say, the parent generation creates this trust and makes a gift into the trust, the grantor allocates their GST exemption to that gift into the trust. And at that point, those assets and whatever they grow to remain outside of the estates of the beneficiaries of that trust for as long as state law permits, and as long as those assets remain either in that trust or don't get distributed out to those beneficiaries. So in this case, how is life insurance involved? Well, assets in irrevocable trusts like this typically do not receive a basis step up at the death of that grantor, who in my example is a parent. And so life insurance is often the asset of choice in funding an irrevocable trust like this, because the death benefit is going to come into the trust income tax free. And so in this situation, counsel can draft this Dynasty Trust to allow the trustee to purchase life insurance on the lives of individuals in multiple generations. That is, client's counsel can draft the trust such that no insured who is also a beneficiary of the trust has any rights that would be considered incidents of ownership over a policy on that insured's life. Why is the attorney doing that? To keep the policies out of the estate of the beneficiaries for estate tax purposes. So some of the advantages, and we'll come back to that behavioral life insurance component here at the end, but some of the reasons why families do this: they're creating a lasting legacy. The trust is a vehicle to help protect the wealth that's in the trust from creditors of the family, including divorcing spouses of descendants who are beneficiaries of the trust. This planning technique, when considered as an overall part of the client's estate plan, might reduce future estate tax liability, particularly in future generations here. And it can also provide liquidity so that trust assets can either purchase assets from the estate of the grantor or other beneficiaries, or make loans to provide the liquidity to pay estate taxes for other assets that do get taxed at the death of that parent or the death of the other beneficiaries of the trust. And of course, the parent who's setting up this trust can have the trust drafted specifically in a manner that dovetails perfectly with the client's own non-tax planning objectives. That is, these types of trust can encourage education in future generations. They can be drafted to encourage productive future employment for future generations, or funds in the trust can be used to invest, for example, in business endeavors. There are a number of things that families can do to create their legacy for multiple generations through trusts like this. As I've said, life insurance is typically the asset of choice to help maximize the effective use of that grantor's generation skipping transfer tax exemption. So with that, let's really get to, how does behavioral life insurance change that conversation? We've planned with these types of trusts for decades. Well, with behavioral life insurance, now picture the parents saying to their children and their grandchildren and their great-grandchildren, your health and your well-being is of primary importance to me. I'm setting up this planning option with the help of my counsel, and it's specifically for your benefit. But you actually are the primary participant in your own health and your own well-being. I love you. I care about you. I want you to engage with this behavioral insurance program. In fact, I'm participating in that program as well. We'll do this together. And so part of the family's legacy becomes a multi-generational legacy of health and well-being. So I really think behavioral insurance is a game changer in a variety of both legacy planning and business planning discussions. The train has left the station on this. I don't believe there's any going back. Behavioral insurance will continue to evolve and get better and better. I have no doubt that life insurance carriers will directly save lives through these programs, because the screenings, for example, that can be provided and other benefits that can be provided actually can and already have saved lives. So with that, let's go to the next slide and open it up for questions.
Yeah, thanks so much, Matthew and John. Before we dive into questions, we'll launch our last poll question. Should be a really easy one. So be sure to answer that if you're looking for the accounting credit. And while people are answering that, I will read out our first question from Stephen. So how are you accounting for adverse selection in these studies? Someone who isn't exercising regularly isn't going to sign up for something that rewards them for exercising. Have you looked at the difference between similar health ratings on your contracts that don't have vitality?
So there's two pieces here that I want to address. I think first and foremost is we are not seeing dramatic changes in either election of a solution like vitality across the board. Roughly about 75% of cases that go out the door at John Hancock have vitality elected. That balance of the 25% are not just the people who are substandard cases. Additionally, the engagement or participation does not really dramatically swing as risk classes adjust and change. And I think that is a common, I think, first assumption is like, oh, my clients are already doing these things. They would be more likely to participate. I would challenge you to think a little bit broader on this. And by that, I mean, let's just take an individual who is table rated. They are 200% table rated or table D or whatever, table 4, whatever we're going to call it. They are table rated due to the fact that they are managing some chronic condition. As a result of managing that chronic condition, they are regularly probably under care of either a specialist or their primary care physician. And one of the key components of Vitality is giving credit where credit is due vis-a-vis regular screenings, health check-ins, blood pressure readings. And in the stats that I shared, the improvements that we're actually seeing are in the space of people who have the most to improve. I'll take it a step further and highlight that there is a flavor of Vitality called John Hancock Aspire that actually is a specific customized version for individuals who may be living with diabetes and actually provides additional credit, kind of almost instead of 1,000 points, it's 3,000 points, so triple the credit for people who are living with diabetes that have their A1C either making improvements of it or actually in a healthy range. So there's actually a lot to kind of go with that. But I would encourage you to kind of think a little bit broader. And one of the key components of the program is that it's not exclusively about exercise. It's designed to be more holistic. That's why screenings are in there, flu shots are in there, meditation and sleep. So it's not just about the physical exercise, but I do think it is obviously an easy kind of jump in thought. So I think that's really important to understand. So there really is no adverse selection.
Much, Matthew. We have one more question from Ronald for John. What was your suggestion about increasing the bonus to the employee, increasing it the longer the employee is with the company? I think he just wants a little clarification.
Yes, thank you, Ronald, for the question. The 162 bonus plan that we talked about is a non-qualified plan type. And so the employer has tremendous flexibility in terms of how they want to increase that bonus. Let me give you the most common method, and that is if, for example, the employee knows that they want to put in, we'll say, $30,000 a year for 10 years as their planned premium. The first thing that an employer might look at is, well, instead of me bonusing you $30,000 of additional compensation, I'm going to gross up that $30,000 to give you more because you're going to have to pay an income tax on that $30,000 that I pay to you. And the gross up amount varies by employer. It's, entirely what the employer chooses to do here. But for example, we might see an employer in that situation say, I'll pay you $40,000 or $45,000. That's going to give you some cash to pay some of the tax on this now $40,000 or $45,000 bonus, and then you pay $30,000 a year for the next 10 years for the planned premium on this contract. It is possible for the employer to ratchet up the bonus. For every year that you stay with me, I'll bonus you a little bit more. The most common design, though, is a fixed dollar amount for a certain number of years.
All right. Thank you, John. It doesn't look like we have any more questions, so I'll just close things out. So thank you both for giving your insights today. It was very helpful. And thank you, FSP, for helping to coordinate this webinar. And of course, thank you everyone for attending. Be on the lookout for an email that will include these presentation slides, a link to watch the recording of the webinar, an evaluation of this event, and any information on CE credits coming in the next day or two. So if there are no other questions or anything, thank you all for attending, and that concludes the webinar.